It's Matt Bennett, Beck's grain marketing consultant, and basically, I want to go over, a little bit about the report. There's a couple, three other things to talk about as well. I did put some slides together here to talk. I had the December WASD here on Tuesday, 11 o'clock Central Time, and so typically the December WASD report is just not a big deal. I mean, they don't even survey the grower for production changes, yield changes, anything like that. It's more of a moving around of demand. If you ever get a change at all, typically you don't really see a whole lot in the way of changes. But we did get a little bit of a movement there as far as the corn balance sheet goes. I'll go into some detail there and just kind of share with you, you know, I'll try to share with you exactly, the way that I see this thing, kind of playing out. But essentially, what it is, you've got you've got I don't know, a nervous trade, if you will. I want to make sure that I get this absolutely correct. And so we'll start with looking at the corn balance sheet. This is from a world standpoint, and I've talked about this a lot over the last year or two. Uh, Maybe you've heard me talk about it, but essentially, you look at this coming into last year, you had 315 million tons of corn. Coming out of this year, 279. So essentially, we're using more corn than what we're growing in the world, which is a good thing. You look at this year, just as an example, this year production up 52.4 million metric tons, which is a pretty incredible amount of production. Why'd that happen? Obviously, the safrinha crop in Brazil was huge. You looked at a big U.S. crop as well, and they're saying that our ending stocks are going to be 279. So you have a drawdown in stocks of 14 million metric tons when we produced 52 more than what we did, a year ago. So, I mean, we produced a big production increase. We uh, had a huge increase, but yet we're boiling through it and then some. And so, from a U.S. standpoint, that's actually, a really good thing. You look at the U.S. supply and demand balance sheet, and it's interesting in that the USDA went ahead and tipped their cap to this huge export pace, just super fast pace. 125 million bushel increase as far as exports were concerned, takes you to 3.2 billion, as you can see on the sheet. If you look down there at exports, what that did is it took ending stocks down to 2029. And in our thought process with the guys that I work with, is that yield should come down in January some. It's hard to know how much. Certainly, there were parts of the West that had best crop ever. There's a lot of other areas where folks said, our crop was pretty good, but not near as good as a year ago. And so you throw all that evidence together, survey-based approach that we've tried to go through, and we're looking for a pretty decent little yield drop. Now, that doesn't mean that this carryout number of 2029 is going to get substantially smaller. If I look, for instance, at our the way that we look at the balance sheet, the way that we try to forecast, this is super busy, but just focus on the three right columns. On the far right, I've got the USDA at 186. Now, I'm not saying they can't go up this next month. It's certainly possible. But if you would go ahead and drop the yield, as I show here, down to 182, which, I don't know that I'm down to 182 right now. I'm probably in that 182 and a half range. We're certainly going to survey the heck out of people between now and then to get a better grasp on it. But one thing that I did was I dropped feed and residual usage from 6.1 billion, which the USDA still has, down to a 5.9 type number. And the reason for that, of course, is we still don't have cattle coming north of the border. Certainly you could hit feed and residual usage at least somewhat if you take supply down. USDA a lot of times takes demand down as well. So we'll kind of see if that's the way that this plays out. You take the yield all the way to 179, which I don't expect. I'm still looking at a carry out in that 1718 range. And why is that important? Clearly last year we weren't able to get the market to race higher, with thoughts of a 1213 type carry out number. And so what it tells you is demand is excessively strong, which is just a really good asset for us. And so if you would have a production issue this next summer, the market's likely to be very, very reactive. Now, last summer, we never really had what you would call a production scare. Second year in a row that the dry weather came in right on the heels of the growing season. And so no one ever really got excited. If you look at the way that this is impacting the chart, I actually just downloaded this chart, right before the podcast. So yesterday, as you can see, there's the yellow lines that go across. If you look closely, yesterday we actually closed above the 200-day moving average. From a technical standpoint, that's actually a really good thing. As you can see, though, from a long-term perspective, we've kind of worked our way into this type of wedge pattern, and we're having a hard time breaking out of it. At some point, we will break out of it, and of course, we all hope that it's to the upside. You always have to weigh the risk that it could possibly be to the downside. But when I think about the things that could potentially drive this thing higher, it's likely going to have to take something in the way of either a production cut in January and or weather issues for the safrinha crop. So those would be considerations. You look at the soybean supply and demand balance sheet for the world, and it's definitely different than corn. Whereas with corn, we're using more corn than we're growing. With soybeans, we're growing more beans than we're using. And so world stocks have built not to a incredibly burdensome level, especially considering you've got Brazil with a massive crop just a year ago. Obviously, forecasts right now are that they're going to have a pretty darn good crop as well. But yes, we're building stocks from a world standpoint, and that's not necessarily going to be what you would call, a bullish argument. You look at the U.S. supply and demand balance sheet, nothing changed here yesterday for the current marketing year we're in. It gives you a 290 as far as the carryout goes, 290 million bushels. And so, your stocks to use ratio is actually relatively thin. There's still some question marks. Now, crush has been fantastic. We've been crushing beans like it's going out of style as we continue to build out this renewable diesel industry, but at the same time, exports obviously have been a hot topic. I mean, there's no doubt that there's a lot of angst as to when's China going to get all of these beans purchased that they've agreed to. We don't have a signed agreement. There's some fogginess, if you will, as far as exactly what the agreement reads. The fact sheet, whenever they had this meeting, was that these 12 million metric tons were going to be purchased by the end of the calendar year. But then there's been some talk out of Washington over the last week and this week as well, that actually it's not going to be done by the end of December. Some folks have said by the end of this growing season, whatever that means. They didn't say marketing year, whereas Secretary Bessent said that these would be done by the end of February. And so there's a lot of question marks there. If I look at, what do you take 53 bushel down to 52? What's it look like? It's a carry out of 226 if you keep demand constant. My thought is that if we trim yield in January, you're probably going to have to pull a little bit out of exports. Our exports have certainly been abysmal, completely converse to what we've seen as far as corn's concerned. If you went all the way to 51, which I do not expect, I could get you a sub 200, but I still expect that we're going to be in this 250 to 300 range most of the marketing year, in all likelihood. If you look at the soybean purchase tracker, this was coming into this week, and I think we've certainly seen some sales here this week, and these are just actual sales to China. Now, there's a lot of sales to unknown as well, and whereas this shows about 25% of that 12 million tons been purchased, some in our industry are suggesting that they've actually gotten closer to 5 to 6 million metric tons, which, is pushing half. And if that's the case, by all means, that's good news. I think that we need to continue to see these sales in the morning. We've seen several of them here lately. But bottom line is, it depends on which metrics you're looking at. We're certainly not going to get this, by the end of this calendar year, if you will, which a lot of us were hoping for. There's your soybean chart. I don't want to spend a lot of time on this one because I want to show you the soybean chart that you can clearly see at the far right what a lot of us in the industry call a head and shoulders pattern. And so, one of the guys in our business put this slide together, and it shows you exactly what a head and shoulders pattern looks like, and what projections might be since this pattern has verified. Could you get all the way down to a 1029? Absolutely. It's problematic, if you will. There's no doubt from a chart standpoint, the bean market does not look great at this point. But again, there's a lot of things that can happen. We haven't had any true weather scare out of of South America yet. There's still a lot of clarity that needs to come to pass as far as this U.S.-Chinese deal. But the bottom line is that from a chart standpoint, it doesn't really look good right now. So we got to hope we can stabilize this market. One area, of course, is this gap. There's a gap down here. We'd have to go down around 20 to 25 cents, depending on which contract you're looking at. But by all means, there could be some more downside in here before the market really gets comfortable with where we're at. Last thing I want to talk about is something that Paul Neiffer put out yesterday. Of course, we heard there was going to be a $12 billion aid package, if you will, for the grower. And Paul is suggesting, based upon the numbers he's getting, that the payment rate for corn would be $48.35 an acre, soybeans $31.77 an acre. These are not from the government. These are Paul's estimations. Typically, he's very, very close to what they're going to end up coming up with. He was able to put all these together. Now, there's no doubt that USDA made it pretty clear that they're actually going to come in and, support other commodities as well, vegetables, all kinds of different things. And so, bottom line is, this is going to be a very interesting, it'll be interesting to just see exactly what we end up coming up with whenever it gets down to the money. You're supposed to get it by February 28th. So I don't know exactly, I don't know exactly what the numbers are going to be, but by all means, we're going to be getting something here. So, you got any questions on anything we put together or talked about here with the market? I know I had a lot of people giving me feedback on, hedging some 26. There's a lot of different ways to do so, whether we're talking corn or beans, but any specifics you want to talk about, I'd sure be all ears. I'd be glad to cover them in next week's podcast. But if you want to, just leave a comment on the podcast, that's fine. If you want to, shoot me an email. It's pretty simple to get a hold of my emails. Well, any of you that read the newsletter, I always attach my contact info so you can get a hold of me fairly easily. So have a great week, and we'll see you again next week.